In this video, I want to show you 3 signs that your portfolio is doomed to underperform. I've seen these mistakes many times for retail investors, and there are some problems that are coming over again and again and again. And these are always the same signs. So in this video, I will talk about these mistakes and how you can fix these mistakes to finally outperform the market. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of roughly 25% per year. And the goal with this YouTube channel is to help you become a better investor. And the first mistake I want to talk about is having too many stocks, being too diversified. If you have a portfolio with more than 30 stocks, 30 companies, this is the most basic mistake. And for most people that have a job, that are busy, they have a family, they don't have the time to monitor more than 30 stocks. I took the example of 30 stocks, but I know some retail investors that have 50 stocks on their portfolio, 70 stocks on their portfolio. And most people, the majority of people, the large majority, they don't have the time to monitor 70 companies at the same time. If you have a diversified portfolio right now, I can ask you a simple question. Do you follow all your companies? Do you know all the companies? Do you follow the margins? Do you follow the problems of all your companies? I know the answer will be no. Nobody has the time to really monitor a diversified portfolio. You don't have the time of a professional money manager. You are watching my channel because you are a retail investor. So you have a job. You don't have the time to monitor this. So the solution for this is to only invest in your highest conviction bets. Because if you have a diversified portfolio, it's like you own the index. The more diversified your portfolio is, if you own 100 stocks, it's as if you own a mini index. So it will be almost impossible to beat the market. I would say it's much better to have a concentrated portfolio of roughly 15-20 stocks maximum and follow them very closely and know them very well so you can understand the moat of each business. And what is great is you can fix this mistake right now, like today. You can ask for all your companies in your portfolio, do I really understand the business model? Do I really understand the moat? Do I really understand the management team? For all the companies where the answer is no, you can just sell it and only keep your highest convictions in your portfolio. The companies that you are really familiar with, that you understand really well. You understand the moat, you understand the business model, you understand the margins, you understand the segments, you understand the incentives, etc., etc., etc. And I'm telling you, for most people, they just invest in some specific stocks because the stock is going up. I've seen this countless times. They see a stock that is appealing on Twitter or on YouTube. They follow blindly somebody else. They borrow conviction and then they cry because the stock is going down. Yeah, guess what? They didn't do the due diligence. They don't do enough research. So this is why. And many people in this situation, they have a diversified portfolio. They own too many stocks, but they don't know why. They don't know why they have too many stocks. They just want to be invested in this flower and this flower and this flower. It doesn't work like this. You will not outperform the market if you do this. You are much less likely to outperform if you have random stocks. You are just collecting ticker symbols. And the goal of investing is not this. The goal of investing is to acquire quality companies and hold them for dear life. So this is the vision I have for investing in general, and so far it has generated 25% per year. So I can tell you, so far it is working. This is a principle inspired by Warren Buffett, Charlie Munger. You want to be invested in great quality companies and just hold them. And you don't need a diversified portfolio to do this. You can have 10 companies. As I'm speaking right now, I have like 12 companies, 12 stocks in my portfolio, but I know them quite well. I know them really well. I follow everything that is happening for 12 companies. This is it. This is it. I know very, very well what is happening. So if there is a stock price drop, you can seize this opportunity to buy more at a discount. Or if there is a problem, I know firsthand what is happening. I know if this problem is big or not. I know if this problem is temporary or permanent. And this is the kind of conviction you need to outperform the market. Sometimes a stock you have will drop 30%. Do you know why? Are you comfortable with that? Will you have anxiety? If you don't have conviction, you will panic sell. Maybe this is a mistake. If you don't have conviction, maybe you will just freeze, and maybe this is a mistake. By having conviction, you know when to pull the trigger. You know what to do in times of panic. This is what I mean when I say having a concentrated portfolio gives you conviction. Having a concentrated portfolio allows you to understand what you're doing. This is how you outperform the market, because sometimes you have to make bold decisions, and you can't make bold decisions if you are too diversified and you don't know what you own. Okay? So first basic mistake, over-diversification. This is too much. Just reduce your exposure to a few companies you know very well. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. The second point I want to talk about is being a hostage to your own emotions. This is something that I've seen too many times. You have some people that are watching their stock prices 10 times per day. People that are having a portfolio, sometimes a diversified portfolio, and they are watching their stock price 20 times per day, 50 times per day, 100 times per day. Will it really help you? If you are a trader, I could understand this. You have some patterns. Some people look at the opening bell, closing bell results, or psychology behind this. But if you are a long-term investor, and if you don't want to buy or sell the stock in a short term, it's a waste of your time, and it will just drain your energy to something that is really irrelevant. In the short term, the market will be crazy. In the short term, people will trade stocks. What matters for long-term investing is the fundamental business. What is the growth rate of earnings per share? What is the growth rate of free cash flow per share? In the very long term, stock prices will follow free cash flow per share, will follow earnings per share. So if you only invest in companies that are growing free cash flow per share at 20% per year, it's very likely you will make 20% per year out of this stock. In the short term, looking at your stock price too much will actually hurt you psychologically and also for your performance, because it will force you to panic sell or panic buy. You will compare yourself to other people, and it will lead you to a lot of pain. So avoid being a hostage to your own emotions. Warren Buffett said the most important thing in investing is temperament. You want to control your emotions, and you don't want your emotions to control you. And looking at stock prices every day, many times per day, will force emotions to control you. You have some legendary investors. I have Guy Spear in mind that says you want to look at your stock prices once per week. If you don't want to buy or sell, if you just want to hold, right? If you're not eyeing to open a position or selling a position, if you just want to hold, just look at stock prices, your portfolio, once per week. If you're a retail investor, you have a job, you have a family, do something else with your life. Do some research, read some other stocks maybe, but not yours. Don't look at the stock prices. If you are passive, it will actually improve your performance. It's a very strange thing, this, but it will avoid all the behavioral rules, the impulse you may have when you trade your stocks too much, too frequently. So being passive will actually help your long-term performance. You will reduce the amount of transactions you have. You will reduce the transaction costs every time you buy, every time you sell, and it will reduce your anxiety. Because if you own good quality companies, normally that should be fine. So there is no value in looking at them and their stock prices every waking hour. Third point I have is a cognitive blind spot. So when you buy a company, when you buy a stock, you are very happy, you do the due diligence, you buy at a good price. Most people look at information that is only confirms their thesis. You have a confirmation bias that is really powerful in investing. For example, if you are bullish, Facebook, for example, Meta platforms, you will only look at the information that is bullish Facebook. And what is counterintuitive is to look at the bear thesis, the bear case for Facebook, WhatsApp, Threads, Instagram. And it is a mistake that a lot of people are making. When you buy a stock, you only look at people that are agreeing with you. And the goal is to follow what Charlie Munger said, is to kill your own idea. You want to be able to tell the other side of the story better than your opponent. You want to know, when you invest in a stock, you want to know what can kill the business, what can destroy the idea, what can go wrong. For example, for every stock that you are buying right now, you can make the exercise, or all the stocks in your portfolio. What are the 3 things that could destroy my idea? What are the 5 things that could destroy my idea? What could go wrong? Is this important or not? Because in the future, maybe in 6 months, 8 months, if a problem happens, let's say in 1 year, and the stock price drops 20%, if you have done the work before, you can actually buy the dip and seize opportunities that the market will give you. You will not panic because you will have done the work before. So you have done the work, you know if this problem is important or not, temporary or permanent. And actually, this is a great exercise for all your holdings in your portfolio. Do you know what can kill the stock? Do you know what can kill the idea? Do you know what are the bear arguments? People that are against you. Because a lot of people are not making this exercise. They just look at confirmation ideas, how great they are. First, it's not good for your ego. You want to be humble in this game of investing. Anything can go wrong. Secondly, you are not prepared in case of a crash. For a lot of retail investors, they invest in companies. The stock is going up, they are very happy. The stock is going down, they cry and they sell. Because suddenly the crowd is turning bearish because the stock is going down. As always, stock prices drive narrative. So when the stock is going up, you will only see thumbnails that are green on YouTube. People will say it's the best business of the world. And then the stock goes down and people say it's a value trap. As always, it's always the case. People will freak out because people don't control their emotions. Okay? And maybe you will be tempted by all these red thumbnails on YouTube, people that are bearish. Maybe you will be tempted to sell because you have not done the work before. So my advice to you is to do the work before. List the 3, 5, 10 things that could go wrong for the business. What are the risks? Maybe one of these risks will come. And if you come prepared, you know what to do. This is a very good idea, a rule of thumb for anything you buy in the future. List the 5 to 10 things that could go wrong. How can the revenue decelerate? How can margins shrink? What if the management team makes a huge acquisition and this is bad? Do they have a good track record when it comes to acquisitions? What if you have a new competitor? Okay, what is the track record of the company dealing with competition? Are they good or not when it comes to competition? Are they good or not when it comes to acquisitions? If the margins are going down, do you know why? Maybe because they have to hire a lot of people. Is this the first time it happens? What is the track record? What is great is everything is public. All the information is public. But very few people are doing the work right now. All the information is free. You can use Gemini to do some research for you. All the annual reports are free and public. But very few people are actually doing the work. So you can actually prepare for the next crash. Prepare for all the risks. And it comes back to my first point. You can't do this due diligence for 70 stocks at the same time. You have to have a concentrated portfolio. Let's say 15 stocks, but you know these 15 stocks quite well. This is a golden rule to outperform the market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.